morning, ladies and gentlemen. Butch Shorak, Options University, Friday, January 20th, 2012. Access to this video is for educational and informational purposes only. Nothing contained in this video, website, or promotional material constitutes a promotion, recommendation, solicitation of any, or offer of any particular investment, security, or transaction. With that, let's take a look at the week that was, as we are in this shortened week due to Martin Luther King holiday. The earnings are the name of the game. They were dominated by the financials. We saw that we expect the financials to be the highest growth rate group for the entire quarter. And one of the key things that you always look for in a bull market is, are the financials and the semiconductors participating? To this point, it appears they are, as many of them have already reported. Citigroup disappointed, but many of them are showing better than expected earnings. And the reason this took place is because of much less expectations created because of forward guidance looking at that fourth quarter. The tech bellwethers have begun to report. Intel, Microsoft surprised with earnings to the upside. Google disappointed as it did not measure up to expectations. Friday morning, this morning before the market opens, GE will be reporting, and we have more than 40 S&P companies that reported this week as we set the pace for earnings. And so far, the general consensus is that earnings are looking pretty decent, even though we have lower guidance and lower expectations. What will happen to the overall trading range of the market? What can we expect out of these earnings? What effect will they have? Well, one of the things you can key on, looking forward, what are we expecting? Are we going to get lower guidance looking forward? If so, could affect the range that we're in. So earnings are the thing that's going to move the market right now as we're looking at the earnings and what happened. If you had economic announcements this week, as we were closed Monday, nothing happened on Tuesday. On Wednesday, we had PPI, which disappointed. We had housing market index also on Wednesday, which surprised to the upside. And we had CPI, which also disappointed. And then jobless claims was a kind of a rosy picture, as we were down at 350,000, which was 50,000 less applying for unemployment than the week before, which was certainly good news. Not a great surprise, since we are talking about some of the numbers that came out of the holiday season. The Philly Fed survey disappointed, and Friday morning we have existing home sales at 10 o'clock, which probably will not move the market all that much. With all that said, what did we get? Well, what we're looking at is rally for those 3 days. There's the 3 days. They're all up candles. And we see that we completely broke out of our previous trading range. And we did it with fair volume. Not great volume. Certainly not excess volume. No 150% of the average volume. But we seem to be in an up cycle. And we've seen that this up cycle has continued for quite some time, as we move from almost 1,200 to 1,300. So we're having a strong move without much of a pullback whatsoever in the S&P, which gives us an indication of the overall market. In fact, let's go ahead and look at this with a little more detail. And we see that during those 3 days, it was absolutely a clean breakout, as we got no confirmation of this gravestone, and it just continued to head up with strong moves for the days, some of them wide range days, much of the move taking place when the market was closed. What causes all this? Where is the news that's caused this? Well, we must be focused in on earnings, because if we look at the rest of the news, it's not a rosy picture. There's all kinds of things going on out there that have happened during the last couple of weeks. Let's kind of review some of those things. We saw that France was downgraded in the last couple of weeks. Spain was downgraded. We saw that Italy was downgraded. J.P. Morgan missed its earnings. It was the biggest start out to the earnings season. Citibank missed earnings. Italy was downgraded. The Chinese GDP was not bad, but the lowest it's been in 2.5 years. The IMF says it needs $1 trillion in order to match some of the problems that they'll have around the world as they support our banking industry. The EFSF slush fund, which is like the Fed for Europe, was downgraded by S&P. And we see that the USA debt ceiling is, again, we're over it. And so we're going to have to put up with the government and put up with the Senate and the House with their fiasco trying to get that passed so we don't close down the government. Home foreclosures are at an all-time high. And finally, to say the least, Wednesday, Germany was downgraded by the S&P. Not exactly a rosy picture, but what do we get out of the market? We call it rally. We call it rally. The VIX is sitting right down there at around 20, sitting just above support if we look back during the last 6 months, and we see that it's sitting there just barely. In fact, it actually dipped below 20. Below 20 is actually our more normal range, as we're talking about more normal markets where it spends most of its time, about 80% of the time. But we, since last August, of course, have had increased volatility in the market, which is amplified or gives us some kind of indication by looking at VIX. If we look at momentum in the market, it's kind of an interesting thing. Let's look at some of the moves. 107 points off the bottom, and then 87 points back down. Stronger up than down. Stronger up, 108 versus 94 down. And then 84, not much of a move up, and then 150 down. This is where we had capitulation. Many of you remember this day in October when the market turned around. We turned into an upcycle and blew right through the top of our trading range, changed our trading range for the fall as we're headed into the end of the year quote-unquote rally. This move was 218 points from the bottom. Quite a move as we saw this take place. And then we saw from 218 it went down 140. This was on a news event, kind of went outside of our trading range. And then we went up, got 110 points, which wasn't that strong, came down only 65 down as we saw this thing turn around, find support on that old trading range, and now we're up 108 points. Is there more room to the upside? How far could we move? Is there another 100 points to the upside? Well, numbers we're looking at are potential in the future. And this is the immediate future. We're talking about 1318, 1339, 1347. These are the areas where the market may be heading as if the rally continues. And remember, the trend is your friend until it ends. And right now, we are in rally mode. Is there reason to be concerned about the air being a little thin up here? Possible rollover? Well, actually, a rollover would probably be pretty healthy. But we seem to have bigger moves to the upside than we expect when it finally moves. And we seem to have bigger moves to the downside when it moves. And all of this being done on a low volume. It is the market as it is. All right, so to the downside, where do we have some support down there if we have a little bit of a pullback? This is options expiration week, and options expiration week, the Friday of it usually gives us some indecision and uncertainty and volatility in the market on that Friday day of expiration. Below us we have support at 1304. We have whole number support at 1300, and then we have much more support at 1293.30 if we do have a bit of a pullback. So we see that, and that it coincides with the top of that previous trading range. Once you break through resistance, it then becomes support, and that support will be tested at some point as we move forward. So that's the week that was. It's what we're looking at, and we've got certain stocks that we've been watching. So those of you that have gold membership, we will continue on in a minute, and we'll be taking a look at these charts of Apple, McDonald's, Nike, WW Grainger, and ISRG as the ticker turns.